For over 10 years, we at Climate One have been engaging policymakers, influencers, entrepreneurs, and activists and scientists in broad, respectful, candid conversations about everything climate. Food, energy, water, technology, transportation, housing. We've had huge success bringing together people who think they're on opposite sides of issues. When they sit down and have a candid conversation, they often find common ground and the basis for real solutions. We're emotional beings. Thoughtful, inclusive conversations create the conditions in which the changes we want to see become possible. So I want to hear from you. When you talk about climate, how do you talk about it? More importantly, what do you want to be talking about? With whom? Join the conversation. Even make your own video. Invite your friends to join you. Let's talk climate. I'm Greg Dalton, host of Climate One from the Commonwealth Club. Welcome to my cozy closet and this conversation about divesting from fossil fuels and investing in cleaner and more sustainable energy and businesses. Bank of the West has been a longtime supporter of the Commonwealth Club and is a fitting sponsor for this conversation. Bank of the West has strong environmental and policies and made the bold decision to restrict financing for coal, fracking, and Arctic drilling to protect our planet. These actions turned away business opportunities and earned it a recognition from environmental organizations not typically associated with banks, including Protect Our Winters, Conservation Alliance, and 1% for the Planet. We're also grateful for the Chan Zuckerberg Initiative for supporting the Commonwealth Club's programs during the coronavirus. We can't convene in person. We'd love to hear from you today, so please share your questions in the comments section on the live stream, or you can tweet them at us using our handle @ClimateOne. We'll use as many as we can during today's show. For future Climate One discussions on coronavirus, economic and climate disruption, and more, sign up for our newsletter at climateone.org. You can also subscribe to our weekly podcast that drops every Friday and is available wherever you get your pods. Today, we're discussing what to do with your investment portfolio. About half of Americans are invested in the stock market, which is exceptionally volatile these days, we all know. Should people concerned about climate change divest from stocks and bonds primarily involved in the fossil fuel business? Or should they seek energy companies that can turn the corner to a cleaner future? What's the role of energy companies in solving climate change? We'll discuss that and more with four distinguished experts. Brian Deese is Global Head of Sustainable Investing at BlackRock, the world's largest asset manager. He served in the White House as Senior Advisor to President Obama and as the Acting Director of the Office of Management and Budget. Lori Keith is a portfolio manager with Parnassus Investments, a leader in the field of investing in companies that consider social and financial results. Pratima Rangarajan is CEO of the Oil and Gas Climate Initiative, an investment fund backed by some of the world's largest oil companies, including BP, Chevron, ExxonMobil, and, importantly, state-owned oil companies of Brazil and China. She previously worked on wind energy for General Electric and Vestas, the world's largest wind energy company. Anne Simpson is Director of Board Governance and Strategy at CalPERS, the California Public Employees Retirement System, the largest pension fund in the United States with more than $300 billion in assets. She's co-author of the new book, The Financial Ecosystem, The Role of Finance in Achieving Sustainability. I want to begin by saying that we intentionally invited these guests, because you have a fiduciary responsibility for managing other people's money. It's easy to get people to talk about what other people should do with their money when those offering that free advice are not legally responsible. So everyone here has fiduciary responsibility to investors. Thank you and welcome to Climate One today.
Thank you.
So I'd like to, Anne Simpson, I'd like to begin with you. CalPERS has been working on climate for a long time. How is this dramatic drop in the stock market? Oil is now at the lowest point it's been in a very long time. It's tickling $20, which is done a couple of times in the last 50 years. How is that affecting the transition away from fossil fuels when fossil fuels are so cheap right now?
Well, thank you very much for having us. CalPERS views climate change as a systemic risk. In other words, something which is going to affect all of our asset classes and all of our investments globally. And the key to addressing that is bringing down the emissions that are causing global warming. So regardless of, the turbulence in the markets at the moment because of the pandemic, which have the cruel irony of actually brought emissions down, so it really shows what can happen when you throw the off switch. We are absolutely focused on the need for this transition so that we get global warming under control. If we don't do that, we're going to be facing a wave of climate emergencies, which are going to require a similar level of response. And the longer we leave it, the more difficult it is. In other words, what we say is, there's a stopping distance here. It's easier to slow down when you can do it reasonably safely than having to slam on the brakes right before you go over a cliff. So, our view of this is the way we need to work. Our theory of change, if you like, is that investors like CalPERS, we are the owners, the co-owners of the companies that are producing these emissions. And our role as fiduciaries, that means we have responsibilities. It's a fancy word for what you need to do when you're looking after someone else's money. Our fiduciary responsibility is to make sure we've got the safety and soundness in this portfolio. So we require these companies to bring their emissions down, typically be about 80 to 90%, so that the biggest emitters in the global economy have got to what's called net zero by 2050. And you'll have seen the news this morning, the latest company in our focus group of the Climate Action 100 plus cohort, Shell, announced this morning that it's committed to do just that. So it's another company acknowledging this transition needs to take place. And although we're dealing with an immediate emergency, we can't, because the house is on fire with one issue, we can't avoid paying attention to other risks, which are going to undermine returns in the short, medium, and long term.
Brian Deese, has the coronavirus crisis changed attention away from the longer, seemingly less acute or urgent climate situation for investors? Are they mainly because the market drop is so dramatic? Has it taken attention away from climate?
Well, look, there's a set of immediate and urgent fiduciary elements, particularly when you see the kind of market dislocation and liquidity issues that we saw in the month of March. But if you step back, I think for us, we came into this year and this pandemic crisis with a view similar to what Anne just described, that climate risk is investment risk, and more generally, that we were on the front edge of a larger decadal structural shift in investor preferences that really changes and upends a lot of how traditional financial models and traditional financial analysis assesses sustainability risk. And as we look at what's happening in the current environment, it actually gives us a very interesting test case to try to understand some of these convictions and some of these hypotheses that we've operated with. So just two quick ones. One is, our perspective at BlackRock has been that integrating sustainability into portfolios builds a component of resilience, which means that you should see better performance in risk-off environments. Well, we have a unique and unprecedented moment here, and what we've seen is if you look at benchmarks, 24, 26 of the major ESG benchmarks have outperformed their parent traditional market cap benchmark. If you look at our portfolios, the sustainability integrated portfolios have really held up quite impressively during this crisis. And then the other element is around, there's been this sense of if there was a severe market downturn, would investors run away from sustainability because they have to focus on other things? And if you look at flows into sustainable strategies, in fact, in the first quarter, you saw record flows and flows uncorrelated with the kind of flight to safety and outflows in other market categories. So I think from our perspective, if you just look at what's happened in the market, we're learning interesting things, but mostly reinforcing some of our ex-ante convictions about the ways in which integrating sustainability can actually improve a fiduciary orientation around investing. Number one. And number two, as we come out of this crisis, I believe that we are going to see key elements of sustainability rise in importance for companies and for governments and regulators as they grapple with the longer term implications of this crisis. A lot more to say about that, but I think that suffice it to say that that our perspective and our conviction around the importance of sustainability coming into this crisis is reinforced by what we're seeing. And I think it's going to likely become an even more central part of the conversation going forward.
Lori Keith, your firm Parnassus has been devoted to that idea that Brian just mentioned, that sort of being good corporate citizens actually drives excellent or perhaps superior financial results. Your take on how this downturn in the market is affecting the turn toward cleaner energy? Is it helping or hurting, or too early to tell?
So yes, I mean, we've been looking at companies that incorporate environmental social governance factors into fundamental investment portfolio strategies since 1984. So that's something that we've looked at as an opportunity, but also identify risk. And certainly coming out of this COVID, we think there's a very structural shift. We're in an era of decarbonization right now, and we think this is a multi-decade trend. As companies continue to decarbonize. And we think certainly, there's going to be, in this immediate environment, there may be a bit of a slowdown. Certainly we're seeing some disruptions right now, for instance, in supply chains for solar panels. Also in terms of implementation of those panels, right? Obviously with everyone shelter in place right now, there will be some temporary delays, but that by no means impacts the long-term strategy. When we look at the significant risk for environmental climate change risk, we think companies, certainly at the state level, are taking very much a proactive role in pushing forward renewable standards. We're starting to see that broadly across many states, and certainly in Europe, they've really been on the forefront of this. So nothing really derails that story. And for us as investors, it's really been a source of alpha to find and invest in a collection of companies that are really best in class around managing their environmental, social, and certainly their governance factors.
And alpha being additional return above additional risk. Is that
correct? That is correct. Yes.
Pratima Rangarajan, you were in the renewable energy business. I'm curious why you left renewables and went to go work for a group of an investment fund run by the largest oil companies in the world. And what is that fund doing?
Thank you, Greg. Yes, I was in renewables for more than 10 years before I took this role. I'm a big believer that renewables has revolutionized the way we decarbonize the power sector. But a few years ago, I decided to just work on climate directly. And so I started studying the data on carbon emissions. And I took home two important learnings. And I think Anne started referred to some of these. At that time, we had less than 2 decades, just like we have now in our carbon budget, to stay under 2 degrees. And with renewables at less than 10% of the energy mix, it just seemed to me that we didn't have enough time to scale renewables to cover the rest of the 90%, not to mention the growth. So we have to work on the rest of the 90%. As I told my kids, I have to stop working the chocolate chips and go work on the cookies as well. But the second realization I came to is that there are substantial sources of carbon that are emitted in this world that are not about energy. And here I can just take cement. It's an example we all know and love. It's responsible for about 7 billion tons of billion tons of carbon dioxide every year. It would be the third largest country if it was a country. And less than half of cement emissions come from the energy piece of cement. The rest of it is really chemistry, because we take carbonaceous material and make it into cement. So it actually just emits carbon dioxide. So when you look at both of those, I realized that I was really working on a small piece of the pie. I wanted to work on the overall climate challenge, which is the carbon challenge. So one of the pleasures of my job is that I can just look at this from the lens of following the carbon. That's what we do in our business. We follow the carbon where there's carbon, it's our job to figure out, to go invest in solutions to mitigate it and then figure out how to scale it up. So I'm following the carbon, Greg.
Right, and it's interesting. There's electric companies, all sorts of interesting companies in the portfolio of the fund that you manage on behalf of those oil companies. Some of the largest financial firms in the world have divested from partially or entirely from fossil fuels. Allianz divested from coal. Chubb, many others, numerous, something like $14 trillion of asset managers have moved away from fossil fuels partially or entirely. Lori Keith, Parnassus did that as a firm in the fall, which until that point you had invested in some fossil fuel companies. So tell us what moved Parnassus to divest and what was really the driver? Was it financial impact? Was it morality? What was it?
Sure. So yes, we as a firm moved all of our funds to fossil free in the third quarter of 2019. Although we did have several funds that were already operating as fossil-free funds prior to that period. So, being really involved, obviously, in the ESG space for many years, we have always, I guess, frankly, coming up to this third quarter of 2018, found it difficult to find opportunities within the energy space that would meet our standards. Certainly, as we're looking holistically at companies, we're looking both at the fundamental, but also at the ESG criteria. And when we looked across the energy space, we were already significantly underweight the space. Certainly, that percentage of the indices has come down. Energy today, for instance, for the Russell Midcap Index is only 3.2% of the index. That's down substantially from, say, 10 years ago. But when we look at the opportunities in that space, we see some very significant challenges. It's certainly from the criteria that we look at in terms of evaluating high-quality businesses, companies that can sustain earnings and growth for a multi-year period of time. We saw a very significant challenge with companies that really don't have a competitive moat in this space. Certainly pricing power is non-existent for energy players, as it's really a price taker market. Second of all, from a relevancy perspective, we think, as we look out, there are going to be more significant shifts away from the use of fossil fuels, and that's going to impact the demand. Certainly, we're already seeing, in this very month, certainly in oil demand is cratering upwards of 30 million barrels a day as the projection by the IEA for this month, and that's expected to continue over the next few months. But even coming into this point, demand had started to taper. The rate of growth had started to slow. So very significant concerns about that. Balance sheet, certainly these are some of the most levered companies in the market. And when we look at the opportunity, certainly in the last downturn, big downturn, 2008, we saw a very significant downdraft in the space. Again, in 2015-16, bankruptcies have really escalated. And I think, where we sit right now, significant over leverage, which means these companies are borrowing very high levels of debt, which will make it very difficult with the current commodity environment to even fund and service that debt. So, credit spreads have widened, upwards of 1,500 basis points in the last month, making it very expensive to fund this strategy of constantly having to spend money on CapEx to drive growth. And by doing that, we don't think the sustainable story, certainly for many of the smaller independents, we think they're going to be very challenged, and the larger players too, that shift is going to take a long time. So, those factors, along with the fact that, from an environmental perspective, this is one of the highest emission sector in the economy. And certainly with gas flaring, we've seen a very significant amount of emissions coming out of that. Even in the Permian alone, I read a stat this week that was saying that they were flaring, upwards of 800 BTU per day, which is enough to power essentially 5 million homes in the United States. So, very significant risk, material long-term risk around the use of water and emissions that we think really make this an unattractive space. And certainly we've been on the right call. The space being down 60% year to date, and over the last decade as well, it's really the worst performing sector in the indices. So, we feel good. I mean, our investors too, I think, being on the environmental social side, we're looking for movement on this area too. So I think it really all aligned from our perspective.
Anne Simpson, CalPERS takes a different approach. It's so large, it's an index investor basically buying the market. So I'd like to hear about that. And we have a question from Cynthia Kaufman on YouTube who says, how can CalPERS justify losing our money in order to engage with fossil fuel companies that are still fighting the transition to a just green economy? It sounds like she may be a CalPERS member. So Anne Simpson, CalPERS approach.
Yeah, thank you very much. The question is, what are you trying to do? So at the moment, the world economy is about 80% dependent on fossil fuels for energy. So what we need to do is get that energy sector changed to a situation where the emissions have come down, as we said, by about 80-90% by 2050 is what we need. And I do want to fully agree with Pratima that it's not just oil, gas that matter here. On the Climate Action 100 Plus list, we have Heidelberg Cement, the largest cement company in the private sector in the world. They're one of the companies that have committed to bring their emissions down to be in line with the Paris Agreement. But also we have utilities. We have companies like Nestle, Pepsi, companies with a very long supply chain in agriculture. So we need to be open and honest about where the emissions are coming from. They're coming from agriculture, they're coming from chemicals, they're not just coming from the fossil fuel sector. Now, specifically on this question, so what do you do about that? Well, certainly for some investors, and Parnassus is an example, choosing to construct a portfolio out of other companies, that makes sense. But for us, we are still exposed to the risk of those emissions. We have nowhere to hide. If these emissions keep rising and causing global warming to increase, that's going to have a knock-on effect on the world economy, on communities right around the globe. And that means simply by having a green, clean portfolio isn't going to help us with this risk unless we actually get the real economy into a green, clean economy. So the reason that we've taken on these biggest emitters, what we're calling the systemically important emitters, these are not the easy companies to deal with, is that their strategy has to line up with the Paris goals. If we don't do that, we can have a neat, tidy green portfolio and the economy can be collapsing around our ears. So our view is that obviously CalPERS is very big, but we can't do this on our own. What we've done with Climate Action 100 is team up with other investors. BlackRock recently joined, which we're delighted about. But the investors that we are working with now have something in the order of $40 trillion that they're responsible for. And because of that, we're starting to see big change at these companies which are at the heart of this energy transition. Today, Shell making its announcement. But if you go to the Climate Action 100 Plus website, you'll see utilities, chemicals companies, cement companies, companies in the agricultural sector moving their strategy to be in line with Paris. And ultimately, that's what's going to protect us from this risk. I want to add one other thing quickly, which is that when we're thinking about climate change, we can't just think about this as some issue to do with science and finance. We've also got to start looking at the people who are at the heart of the impact that climate change is bringing. So something which I think we're learning in this pandemic is to put people at the center of what we're thinking about. So at CalPERS, we call this human capital. It's financial capital, human capital, natural capital. And in our engagement with companies, in our work at the SEC, we're saying that companies need to be reporting on issues like health and safety, employee engagement, workforce turnover. Because if we don't take care of people in the process of this transition, we simply won't achieve the consensus from the public, the private sector, and from civil society. So really, this is the name of the game here is change. we're too big to walk away. And even if we did walk away, we're still going to get hit by what's coming down. We've actually got to change the course of events. We can't sit and be the victim of the course of events. Even if we were so big, we could actually construct a portfolio that looked neat and tidy and green. I've got to be in the business of transition.
Brian Deese, BlackRock is the largest investment manager in the world, also mainly an index house where you buy indices that are constructed by other companies. You think that divestment is simplistic, it's the wrong frame. There's maybe a bad title for this conversation. And get your challenge on divestment. It's too simplistic, too binary. What's wrong with divestment?
Well, I guess I'd say a couple of things. The first is that I think we come at this from the perspective of risk and investment risk, and trying to fully understand and reflect the risks that we're all talking about here into investment processes. We did announce earlier this year that on our active portfolios, which means the portfolios where we have discretion when we're managing a client's assets, we did announce that on that portion of where we have discretion, that we'd be exiting all of our exposures to thermal coal producers, because that was an area where we identified that we think that the risk, the business model risk itself, is pronounced enough to warrant that. But as we look more broadly and we look at these risks, I would make 2 points. One is we are very focused on this issue of transition that Anne just outlined in 2 respects. The first is trying to understand which companies and which business models today are the most well prepared to actually navigate effectively and, in fact, effectively take advantage of what we believe will be an accelerated transition toward a low carbon economy. And if you take that perspective, what it allows you to do is not look, for example, at the entire energy sector or all companies that are involved in traditional energy and look at them sort of monolithically, but instead say some of those companies are making significant changes to their business model, taking a lot of their current R&D and CapEx and investing it in different ways, and some of them are. And from a risk perspective, investment perspective, those differences are really important when you're trying to think about which companies will actually be best positioned in the future. And we use that not only in terms of allocating risk capital, but also, as Anne said, engaging with companies where we own equity in those companies on behalf of our clients. And that, as Anne referenced, is connected to the work of Climate Action 100 that we are now supportive of and partnering on. The last point I would make, though, that is connected with transition is that ultimately the pace of the global low carbon transition will be dictated by the ambition and the effectiveness of government policy globally. And as somebody who spent a lot of time working to and getting the Paris Agreement agreed to and then entered into force in 2015 and 2016, I think you look at that framework and you see in it the potential for countries to increasingly increase the ambition of their national policies, their nationally determined commitments, in a way that would signal the long-term trajectory of how the economy will decarbonize. That would then accelerate massive transformations of capital and shifting of private capital. Obviously, the state of global policy is not where it needs to be. I think that we will see an acceleration, but the more that ends up happening too late and in an uncoordinated way that doesn't provide those long-term signals, the more challenging it's going to be for capital to actually move and accelerate this process. So that last point is not to suggest that it's all or nothing. We used to have debates in the White House that were really unhelpful. Is it all the public sector? Is it all the private sector? Is it all policy or technology that are going to solve these issues? The answer is a complicated intersection of both. But I do think it's important in this conversation that if we actually ask the question of what is going to be most transformational in really driving us to the acceleration that we need, particularly over the next decade, in much more rapidly putting economies on a decarbonization pathway, public policy and government signaling clearly toward those long-term efforts is essential.
Brian, as someone who's worked on Paris and now and working in the markets, we have a question from YouTube from Fossil Free California that says only 9% of the companies in the Climate Action 100 Plus have plans that align with the Paris goals that you helped bring into action. Will BlackRock increase the pressure on these companies to do more?
Well, it's a good question. I'd say a couple things. One, our CEO in January outlined a letter that outlined our expectation for companies that we engage in, that they be able to develop and disclose publicly a plan for how they would operate in a long-term Paris-aligned outcome. Meaning, if we succeed in achieving the reductions in global average temperatures that are required by the Paris Agreement, companies need to disclose a plan for how they intend to operate in that environment. That's number one. Number two, as you see more companies like, as Anne mentioned this morning, with the announcement from Shell and others, actually on their own stepping up and developing not only plans, but announcing this as their business strategy, you're going to see more competitive pressure in the market. And to the conversation we were just having about transition, that is going to increasingly demonstrate which companies are actually investing in this as their play for the future versus those who are not. And that provides very valuable information for investors to make judgments. So that is a place where we have signaled our intention to make clear our expectation of companies, and then align our stewardship and our engagement with companies with those expectations.
Pratima, I want to ask you, the whole divestment conversation focuses on publicly traded oil companies. People who know the markets deeply, most of the hydrocarbon reserves are actually held by state-owned oil companies that shareholders' divestment can't get at, China, Saudi Arabia, et cetera. So actually, you have a window into that world because a couple of state-owned or semi-state-owned oil companies from Brazil and China are involved in your work. So tell us what window you have into the big part of the oil market that is not talked about in this whole divestment conversation.
That's absolutely right, Greg. I think divestment has done a good job in raising public awareness about climate challenge, and that is important. But in terms of actual climate impact, we don't really see it on the emissions. And that's because it's not really effective. Divestment isn't such an effective tool where other forms of investment or other forms of capital are available. It's not a great tool when you think about nationally driven, as you said, oil companies, which is where a lot of this is. And it looks at all fossil fuels as the same. Whereas when we need to solve real problems, we have to be contextual. And we have to look at what countries, what regions are capable of, and what they need as well. A one-size-fits-all approach is great on paper, but in reality, one cannot use the same approach in Europe and in Africa. In Africa, 57% of the population doesn't even have access to basic forms of energy. It just isn't the same story. And as Brian said and Anne said, we cannot forget people in this. It has to be an equitable and a just transition. It cannot just be financial. So, and I think and if you look for something that's really a much stronger, potent tool in answering the climate challenge, I absolutely agree with Brian. It is policy. Policy can drive us to scale a lot faster, and we can actually hit the carbon challenge in the time frame we have. And the first thing there is to put a value on carbon. In 2 centuries of economic history tell us that we will not change behaviors unless we value what we are talking about, and we need a value on carbon. That's just plain and simple. And we need to put all our political will behind this, all our economic and political. From an investor viewpoint, I think it is much easier to do. I think it's much more effective to do what Anne and Brian were talking about, which is work with the companies, work with entities, work with regions to reward companies that are ahead of the curve. And that's really important. What we're seeing with the divestment regime is that there are some real regions of need where we have to take a much more nuanced view. And so we're making no progress instead of making substantive progress, because all or nothing is not a very good option everywhere.
Well, let me jump in there on the political will because, excuse me, let me jump in there on the political will. The companies that have invested in your fund, BP, Chevron, ExxonMobil, and some European companies are also, that's like an interesting technology bet, and they're trying to learn about the future and make some very interesting investments that people wouldn't expect oil companies to invest in. And you talk about we need political will. At the same time, those companies, with the exception of BP, which just pulled out from the American Petroleum Institute, they say publicly we need a price, or you say value on carbon, because they don't want to get involved in carbon tax or cap and trade. But then they also support the American Petroleum Institute, which does everything it can and spends millions of dollars lobbying in Congress to prevent a price on carbon and to oppose legislation to do the kinds of things that they publicly support. So help us understand that there's an inside game and an outside game, and corporations are not monoliths, and there's different power centers and conflicting interests. But since you mentioned political will the industry use its political muscle?
Yeah, and I have a comment on that too, Brian.
Anne, would you like to go first?
Yeah, I mean, only because you're receiving, if you like, venture capital funds, and what CalPERS and BlackRock and others are doing with the companies is getting this political lobbying issue dealt with. So we're calling for, first of all, with these companies, governance overhaul. It means the board takes responsibility, we hold them accountable through our votes, but it also means lining up executive pay, the rewards, with the new goals of reducing. And we do not want shareholder money being used for lobbying purposes that undermine the commitment that these companies have made to supporting Paris. So you'll see the companies that you've mentioned, including Shell, including BP, including others, which have agreed to review, revise, and pull out of trade associations. They're not lined up to support this. But for all of those of you looking at the proxy season, you'll see there's a whole string of share owner proposals coming to other companies, calling upon them to do the same thing. In other words, what you say and what you do with shareholder money has got to line up. So that's one thing. The owners have got to get this all in check. Secondly, I just want to flag that many of the investors who are involved in this work also are part of an initiative called the Investor Agenda, which is being coordinated by the same investor networks like PRI, Ceres, IIGCC in Europe, and their counterparts in Asia and Australia. What that group is doing is focusing on a whole range of issues in the policy framework, which are going to make all the difference, because Pratima's right. This can't be done just through engagement. So our strategy at CalPERS is three-part. It's engagement, it's advocacy with policymakers, where carbon pricing, mandatory climate risk reporting are just two examples of what's on that measure. And then thirdly, integration. And that's where we take what we're learning about the transition, not just to manage risk, but also to find the opportunities. So you'll see even in our portfolio, we have in private markets something like $12 billion invested very productively in the broad theme of climate solutions. So this is not just a one-way street. This transition is opening up a lot of opportunity as well. Thank you.
There's divest on the invest side. If you're just joining us, we're talking at Climate One today with Brian Deese, Global Head of Sustainable Investing at BlackRock, the world's largest asset manager. Excuse me. Lori Keith, Portfolio Manager at Parnassus Investments, and Pratima Rangarajan, CEO of the Oil and Gas Climate Initiative, an investment fund backed by some of the world's largest oil companies, and Anne Simpson, Director of Board Governance and Strategy at CalPERS, the California Public Employees Retirement System, the largest pension fund in the United States. I'd like to go to our lightning round and ask some true or false questions for our guests, beginning with Lori Keith. In February, Harvard faculty overwhelmingly voted in support of a call for the university's $40 billion endowment to divest its fossil fuel holdings. As a graduate of Harvard Business School, do you agree or disagree with Harvard faculty?
True. Agree.
Brian Deese, Yale, your alma mater, was ill-advised when it divested from coal and tar sands investments. True or false?
I was wondering where the next alma mater roulette was going to go. Look. I think the answer there would be. My answer there would be. It's not as simple as a true or false answer. You got to start with this from the perspective of risk, and when you do that, I think there are justifiable approaches that are sectoral based, but that mostly the opportunity is to look at this in terms of relative laggards and relative leaders within industries.
Anne Simpson, true or false, divestment from fossil fuels is a feel-good gesture that has zero financial impact on the targeted company.
Well, you said it.
So that's a yes. Lori,
Do you want to look good, or do you want to roll your sleeves up and get involved in this messy business of change? I do want, for the record, though, to say that CalPERS several years ago did sell its holdings in companies with a majority of revenues from thermal coal. However, that was after an engagement process in which we, decided to keep several, which were involved in the transition, but the others, we didn't see the transition opportunity. So just, investment decisions have to be kept under close attention. Thank you.
Thermal coal is kind of easy to get out of. Once an industry is kind of dying, then a lot of people head for the doors. True or false, Lori Keith, by sticking to its index strategy tied to market capitalization, CalPERS is going to ride the energy sector down. For Lori Keith. True. Pratima, true or false, battery storage is hot and sexy.
Absolutely.
True or false, Anne Simpson, picking individual stocks is a fool's errand.
Well, a fool and his money are soon parted, as has been said. Stock pickers have not been able to beat the market, and at our size, when you're our size, you cannot, like a small investor, construct an active portfolio. No, it's a fool's game. Agreed.
True or false, Brian Deese, markets move faster than government, so there's no need for policy to drive a faster transition to cleaner energy.
False.
True or false, Pratima, mining lithium for batteries is a clean and sustainable enterprise.
It can be, but what lessons have we learned from history? Let's make sure that BlackRock and CalPERS are keeping all the miners clean and making sure that they are doing this in a sustainable way for the future.
True or false, Anne Simpson, before you moved from the UK to California, you thought everyone here wore tie-dye clothes and had flowers in their hair.
Yeah, it was such a disappointment. I thought I'd be tie-dyeing my suit, my daytime suit in the bath. Yeah, true.
Also for Anne, true, today they are once again wearing tie-dye shirts and not taking showers as often.
In California, I'm sure it's all very good for saving water.
There you go. True or false, Brian Deese, pension funds have return targets that are highly unrealistic.
I think there's a spectrum of pension funds, spectrum of return targets, and some of them are unrealistic and some of them are probably overly conservative.
True or false for Pratima, wind and solar energy can power cement and steel factories more cleanly.
They can power a lot of the auxiliary systems in cement and steel factories, but still in the kilns, the actual heating mechanism requires very high temperature thermal energy. So there's a nuanced answer, yes.
Yeah, wind and solar can't quite get there. So wind and solar can't power, some really heavy industry. For Lori Keith, true or false? The financial crisis caused by coronavirus is so severe that ExxonMobil laid off 34 members of Congress.
No.
Lori?
False.
All righty. Thank you for getting through the lightning rounds. One of the more memorable and fun parts of Climate One. I do want to talk about the clean side. We've been talking about the dirty side. Let's talk about its divest and invest. So, we've seen some, Lori Keith, we've seen oil companies move into renewables. I've been doing this long enough that it's kind of like the hokey pokey. They put one toe in, they pull it out, they put one toe in. Is there meaningful investment now as a measure of percentage of their overall capital expenditures or CapEx that fossil fuel companies are going toward cleaner energy, or is it just kind of greenwashing and marketing? Is there real money being put by fossil fuel companies to alternatives?
As investors, certainly in the mid-cap space for Parnassus mid-cap fund, we're not seeing that. Certainly across many of the shale independents in North America, we're not seeing any movement towards renewables at this point. All of the capital expenditures are really going back into the ground to try to enhance recoveries in those existing shale wells or for additional acquisitions. And so, we think there has yet to be an appetite to really shift away from fossil fuel and shale development by many of the players. Certainly there are, those one-offs, internationally, and some of the very large players that are starting that route. But we think it's going to be a long road, frankly. And, in the meantime, we think there's going to be significant risk to many of the players, particularly, when we're looking at commodity prices today, certainly $20 per barrel on the West Texas Intermediate, today's price at that level. Certainly, the Kansas City Fed put out a projection that 40% of energy companies in North America potentially will be bankrupt within 1 year at this commodity price, many of those being smaller players. But we think there's very significant risk. And so as an investor, you're really having to bet on an increase in commodity price for these stocks to work, and the economics simply aren't there.
Pratima, Lori Keith talked about the mid-range companies. You deal with like the super majors, the global giants. We have a question from Lala on YouTube. Will the oil and gas companies invest more or less in clean tech in 2021? So what are you seeing? I understand that your fund is separate from the companies. They all put some money in. It's a separate entity. But does that trickle into larger investments by the oil and gas companies and some of the clean technologies that they might discover in your fund or learn about?
Yeah, absolutely. So 2 points. One is that the money they put in our company is separate from what they already do. So if we look at Equinor, they do offshore wind. Every one of the companies has their own portfolio of clean technologies. But if we look at,
to be fair, it's a small part of their overall expenditure, right? I mean, it's 1%, 2%. I mean, of what they spend.
Well, it is a small part, but when you look at what it actually takes, the capex it takes to go drilling for oil, it's not the same capex when you set up a wind farm. Mm-hmm. Right? I come from the wind side of the business. We just don't run so capex rich in general. And I think you're going to see that changes. You're going to see the changes in the business models because that's what we need. The world is going to need it. COVID's going to, I think, in some ways increase the pace because we're going to have recovery plans. And it's always good. Sometimes crisis makes you look at things very differently. We're not going to come back to the same place. But in terms of our fund, the $1 billion+ that we have in our fund, so the OGCI member companies do give us that as a investment capital. But in addition to being investment capital, they also co-invest with us in some of our investments. They actually, but most importantly, they our collaborators. They take our companies, our innovations, they pilot them, they test them, and they're actually deploying them at scale right now. So that's really important because we need to shorten the time for commercialization, time for impact. And then when we also take on some difficult projects, that's when they become really, really important partners for us. They take it over from us. So in the UK, we have a carbon capture, utilization, and storage project. It's very ambitious. CI grew it over the last 3 years. And the goal is to decarbonize the entire northeast of England. And this project grew out of our capabilities as a small investment fund and has now been taken on by 5 of our OGCI member companies. And they're going to take it out to operationalize. Now, this is not a typical type of project. This is really important for a couple of reasons. One is not a typical project that they would normally invest in. They're doing this in order to demonstrate that we can decarbonize industrials across an entire region. When they do this, what's the most important thing is that they will be able to transition the technologies, the resources, the knowledge they have into the industrial sector and allow for the decarbonization of a neighboring sector. So these are all the ways we work with them. So yes, the impact is much broader than what we do as a fund. We're just the catalyst.
Anne Simpson, what are some of the bright spots you see on the clean side? Because we've been talking a lot about getting out of the dirty, capital needs to go into the clean side. What are some prospects that you see, areas that you see that CalPERS has invested in, and how much is CalPERS investing on the green side?
Right. Well, of course, as we're calling on companies in our public side of the portfolio to make the transition, that what follows from that is inevitably, and rightly so, a shift in CapEx. On the private market, we have something in the order of $12 billion, which we've invested in a range of different businesses, water storage, renewables, solar, wind, and so forth. Now, as everyone has stressed, the reason CalPERS invests is to help pay pensions. So when we're looking at these opportunities, the standards on the due diligence for risk and return are not somehow more lax. These projects that we're finding currently, to the tune of $12 billion in private markets for us, have met very exacting standards. And, it was said earlier that pension funds have different target rates of return. I mean, if you're talking to the Japanese government pension fund, their rate of return, their discount rate, if you like, is 1.9. You talk to some of the big Dutch pension funds in Europe, they're looking at 3%. At CalPERS, our discount rate is 7%. So we can't compromise that in order to push money around in a good cause. We've got to be able to walk and chew gum. The walk is we've got to hit the investment return, and we've also got to address this climate risk. And these opportunities that are coming forward are that sweet spot where that's all possible.
Brian Deese, there's some fundamental questions here about being raised in the political campaign and broadly, even by there's some generational divides here, questioning capitalism and the core tenets of capitalism. And the leader of your company, Larry Fink, has come out and sort of said that shareholder primacy is not the only thing that should guide companies now. We're coming out of this COVID crisis where a lot of things are being questioned. So how is the role of shareholder primacy at a time when we've had this, economists will say this recession could be as bad or as big as the Great Depression, and should shareholders be king as society reorganizes itself after COVID?
Sure. Well, I'd start by distinguishing between shareholder primacy and capitalism. But in the context of shareholder primacy, I think for some time, our CEO, Larry Fink, has been arguing that we needed to have much more focus on long-termism, and in particular on the issue, the concept of a company's purpose. And the company's purpose is really its strategy to deliver to all of its stakeholders, including its shareholders, but also its employees, the communities that it operates in, and its customers and consumers as well. And the focus on purpose has been because of a view that we integrate into everything we do. That in fact it is that focus on serving your shareholder, your stakeholders more broadly defined, that actually will drive long-term profitability. So this is not about shifting away from a focus on what will actually generate sustainable long-term financial returns, but instead a widening of the aperture to recognize that, in fact, if you're a company that mismanages your relationship with your employees, if you're a company that isn't aware of how you are perceived in the communities in which you operate, you can quickly lose your social license to operate. It can be much more difficult for you to attract and retain the best and brightest talent. And these things affect your ability to profit over the long term. And so that is a view that we have had and has been, frankly, was more controversial several years ago. I think we've been heartened to see many companies, and in fact, even the Business Roundtable, come around and articulate that view more broadly. But what I would say in the current crisis, I think we're seeing in extraordinarily striking ways the importance of a company understanding how it is managing the health and safety of its employees, the way it actually can engage with the local communities it operates in, and also its resilience to threats, whether that be to its supply chain or to its customer base. And I believe that as we come out of this crisis, and I agree that the path out of this crisis is going to be difficult and challenging, and the implications in terms of the inequality and the scarring on people could be much more significant than the devastating financial crisis that we all lived through 12 years ago. As we come through that, I think the questions of how companies are managing their relationships with their stakeholders, more broadly defined, will become even more and more important. Certainly, we're seeing that already, and it's certainly something we are extremely focused on.
So it's one thing for the Business Roundtable to say, shareholders are not the only people that matter, but doesn't there need to be some change in regulations and rules and legislation, because the laws and the regulatory structure is still in place that fiduciaries have to maximize return, financial return, and they can get sued if they don't. And that's still gonna, right?
Well, first I would say this is a global conversation, right? And the regulatory environments and the regulatory definitions of what a fiduciary of the fiduciary standard differ globally. So that conversation in Europe, both from a regulatory perspective and from a societal expectations perspective, is different. I do agree with you, though, that when we think about what actually are the drivers of long-term profitability, we need to have regulatory frameworks that allow and, in fact, encourage consideration of these broader elements, and that to the degree that companies are in fact constrained to not actually factor in issues like how they're managing their relationship with their stakeholders and their ability to set a goal connected to its long-term purpose, not more to a shareholder-centric view and married to quarterly earnings at all costs. To the degree that regulatory structures impede that, then we need to be questioning those, because ultimately, that is really where the opportunity to get sustainable profitability over the long term will come.
If you're just joining us, we're talking about investing in fossil fuels and cleaner forms of energy at Climate One. I'm Greg Dalton. My guests are Brian Deese, Global Head of Sustainable Investing at BlackRock; Lori Keith, Portfolio Manager with Parnassus Investments; Pratima Rangarajan. Am I saying that, Pratima?
Perfect.
Pratima Rangarajan is CEO of the Oil and Gas Climate Initiative, an investment fund backed by some of the world's largest oil companies; and Anne Simpson, Director of Board Governance and Strategy at CalPERS, the California Public Employees Retirement System, the largest pension fund in the United States. We have some questions from our listeners. One on YouTube says, "Thanks for holding this. I'm interested in learning ways I can encourage my employer to require 401k fund managers to offer socially responsible investing or environmental, social, and governance, clean, socially responsible funds, and preferably funds committed to fossil fuel free. Anne Simpson, how can someone get their company to do more, their employer?
Maybe the first thing is Climate Action 100 Plus is open for all investors to sign up for. What that means is you join a global coalition of investors who are driving what we say, this is driving business action on climate change. So that is something that's open to all. In terms of finding employers to sign up for a 401k or a pension scheme, which can give offerings that tailor to the concerns that you're raising, that isn't something that CalPERS does for others. We have 3,000 employers in California who we serve, but we don't have commercial offerings for companies.
Sure. Yeah. I don't think he was saying that CalPERS is not available to him. Another question from John Murphy on YouTube. I want to invest sustainably, but I'm overwhelmed by the enormity of Googling green investing or sustainable mutual funds. Can someone please suggest good information sources for individual investors? Lori Keith, where should a person who wants to go green look for investment information?
That's a great question. I think, first of all, I would suggest, really looking at the spectrum of what the offerings are, certainly going directly to websites offered by individual mutual funds. As an example, you can really get a sense, what is it that they own? Because I think it's really important, as an end investor, to understand what are those companies that are truly being invested in, how are they disclosing, for instance, their proxy policy, how are they voting as it relates to issues around climate change. Full transparency, I think, is really important. And so I would definitely encourage one to go out and look at the information that's provided on those websites, see if there is a report, any sort of shareholder sustainability reporting that is provided on an annual basis, an engagement report, see what type of engagements that firms are involved with. For us as investors at Parnassus, we're very actively involved in engagement efforts with a number of our investment holdings, and we report out on what we're doing and what stage those engagement efforts are in. So I think that can be very helpful, but I do think it's really important to understand, because there are a lot of firms that will say, check the box to say we're doing environmental social governance investing, but when you look behind the scenes and see what companies they're investing in, most of those wouldn't even meet the standards as it relates to environmental social governance standing. So I think it's really important to understand what you own. And I would definitely recommend going directly to websites and look at the shareholder reports. Certainly, for myself, I just authored the recent quarterly report that will be coming out shortly. We do that every quarter, and you can read through those reports and in plain English and see, what the strategies are and what they're investing in. I think that's really important.
Sometimes they're in plain English. Another useful tool is fossilfreefunds.org. Really useful tool. You can plug in the ticker for any climate, any fund, and you can see that a lot of the funds that pretend to be fossil free or low carbon, there's a lot of carbon in there. Brian Deese.
Exactly.
Yeah, I just wanted to pick up on this and say something that Anne said earlier about, we've learned from decades of financial research that the most important decision that an individual investor makes is actually at the portfolio construction level. Mm-hmm. And so, and one of the things that's really exciting about the space that we're in now is, whereas a decade ago, it was much more that actually people's choices were constrained to a limited number of sort of sustainable funds that were in one sector, so just equity, not fixed income. Maybe it took a lot of risk, which might be appropriate for somebody who has a very significant risk appetite, but not build a whole portfolio. Now there are a wealth of building block exposures, low cost, straightforward, that an investor can start. So I would say the other thing you could do is start, whether it's with your financial advisor or with websites like you're saying, and start at the initial question. If you're building a 60-40 portfolio, how can you think about embedding sustainability in the core of what you're doing? not just in thinking about having a satellite exposure to 5% of the money in your portfolio to go into an SRI fund. That's a really exciting change, and we're seeing a democratization of access to underlying building blocks. Now, to your point, you need to look at what below the headline label. You need to understand, particularly if you're getting screened funds, what they screen out. I would say, in fairness, there is no one unified definition of fossil fuel. Every company, including renewable energy companies, consumes energy of one form or another. But with that said, the number of choices and the quality of products has exploded recently, and I would just encourage, think about that question when you start building your portfolio, not just when you're at the end and you say, I want to get some exposure to an SRI fund.
And as we wrap up, I'm hearing this, conversation again, thinking about, half of Americans don't have participation in the market, and we're in a time of severe economic distress where people are difficulty paying rent, unemployment is in the double digits. So I want to end and think about, ask of you something you're grateful for, and something that maybe evokes some empathy for people who feel frankly excluded by this conversation we're having because they don't have access to the markets and retirement plans, because so many Americans and others live paycheck to paycheck. First, let's start with Anne Simpson.
Yeah, no, thank you very much. Retirement security is something that should be for everyone. We cannot have, an island of comfort floating in a sea of misery. CalPERS relies for its own members. We have nearly 2 million members in our pension fund, but it's absolutely good for the capital markets to have this type of long-term savings. It's absolutely right for our members that they have dignity in retirement, and that should be something that all communities can rely on. It shouldn't be viewed as a privilege for a few. It's good for the economy, it's good for communities, and it's most definitely good for people in their vulnerable years. So CalPERS is a great supporter of retirement security for all. That's essential.
Pratima, you spoke earlier about other parts of the world that are less energy fortunate than we are talking on this conversation. Your thoughts on kind of empathy and gratitude at this time of global economic pain?
Greg, I think COVID has shown us some of the real gaps in our society when it comes to healthcare, when it comes to social net for people, even young people or older people. Both parts of society are finding themselves in difficult times right now. There are kids out there who are not getting their meals when schools are not open, right? And there are some real parallels between what we're seeing in COVID and the climate challenge. They're both going to affect the people at the difficult parts of society where, the poorer parts of our society more. They're going to affect some poorer nations more. And I think we really got to start thinking about coming out of COVID-19 as we look at our economic recovery plans. We really got to think harder about our social recovery plans. And how do we transition even through this climate in a just, equitable way for all? It is where I hear the most about divestment is in the halls of Imperial and Oxford and Cambridge when I'm in London. I don't hear about it when I'm sitting on a panel in India. There they ask, please, can we have gas power? Gas is too expensive for us, but the coal is choking the kids. The emissions, in Delhi were terrible. So it's just I think we do have to think about, we're very privileged. And there are multiple ways of, multiple lenses we should be looking at the world right now. And I hope maybe COVID has really opened our minds to some of that.
Brian Deese, your thoughts on that privilege at this moment when there's so much pain in the economy?
Look, I'm enormously grateful for the health of my kids and my partner and my family. I'm incredibly grateful and awed by the heroism of the frontline workers and healthcare officials who are not sitting as we all are in our homes, facing challenges of our own, but are out on the front lines helping to fight this physical threat to our lives and our economy. And I'm also very aware at this moment that, as Pratima says, these types of physical threats are accelerants to the type of inequality that was already really hitting societies within countries and between countries. And if you live in Atlanta today, you're 15% more likely to die from coronavirus than if you live 15 miles outside in the suburbs, because the local air quality in Atlanta is bad and it exacerbates respiratory diseases. As we move into the winter in the Southern Hemisphere and we see this crisis extend into emerging market economies, we're going to see the kind of disproportionate impact where you see the intersection between air quality and pandemic. We know that the intersection between climate change and disease. It was coronavirus here, but we see the extension of vector-borne illnesses as climates change, and in fact, as habitats and humans start to intersect with each other. And in fact, animal-borne disease or diseases that initiate in animals are much more likely to occur and spread as climate change forces people into closer proximity. And so as a global community, we need to be much more capable of actually preparing and being in front of this. But I would say, to your point about gratitude and empathy, I would add to it urgency, because even as we're talking about these sort of how do we get to these longer term issues, the actions that government policymakers, that first responders, that health professionals and then investors take in the next weeks and months will help to also reinforce whether or not we can come out of this having blunted some of the worst impacts of that or not. So I also, in addition to feeling that gratitude in the sense of connectivity to these larger challenges, I also feel a certain urgency around making sure that we're doing everything we can to not have the impacts of this crisis, which already will be huge, even more as we move into the next phase or phases of this epidemic.
Lori Keith, what gives you hope when you think about urgency, gratitude, and empathy? What gives you hope?
I would echo much of what's been said so far, but I think, we're very fortunate. I saw a Wall Street Journal article today, highlighting that only about 37% of Americans can actually work remotely. So I feel very fortunate that I'm one of those people that are able to continue my job, work remotely. My 3 children are all able to continue with their distance learning. But frankly, there's a whole rest of the society that is not able to do that. And so, we have essential workers really on the front line, whether it be healthcare professionals, first responders, grocery clerks. Many of them, historically haven't really been taken care of in terms of worker pay, benefits, things that are, now considered very essential for our society to operate. So I think this emphasis around investing in human capital management, investing in employees, I think that is something, as we look to invest in companies that are going to be sustainable over multiple years, that is such a critical function. And I do feel very strongly that coming out of that, there's going to be this resurgence of making sure that companies are aligning their longer term strategy with really investing in their talent base. That's really critical. So that's one of my hopes, and certainly one of the structural shifts I hope comes out of this.
Well, I'm grateful for working with the Climate One team for making this engaging podcast and radio show and live stream happen from their homes using new tools. You're fabulous. I'm also honored and privileged to talk with you, Anne, Brian, Lori, and Pratima about issues so important for our present and our future. On Climate One today, we've been discussing what to do with the fossil fuels in your investment portfolio if you're fortunate enough to have one. Dump them, keep them, or a little of both. We heard arguments in favor of divestment and putting social and moral pressures on fossil fuel companies to move faster toward cleaner forms of energy. We also heard that divestment has no meaningful impact on the finances of fossil fuel companies. I'm Greg Dalton, and my guests today were Brian Deese, Global Head of Sustainable Investing at BlackRock, the world's largest asset manager, and Lori Keith, Portfolio Manager at Parnassus Investments, which has divested from fossil fuels, and Pratima Rangarajan, CEO of Oil and Gas Climate Initiative, an investment fund backed by some of the world's largest investor and state-owned oil companies, and Anne Simpson, Director of Board Governance and Strategy at CalPERS, the California Public Employees Retirement System, the largest pension fund in the United States. She's co-author of the new book, The Financial Ecosystem, The Role of Finance in Achieving Sustainability. Podcasts of this and other Climate One shows are available wherever you get your pods. Please help us get us more people talking about climate by giving us a rating or review. It really does help. Thanks for joining us online for this live stream. Thank you for your questions. We'll see you next time, everybody.
Thank you, everyone.
Thank you.
Thank you, Greg. Thanks, everyone.
Thank you.
That was fabulous.
Terrific.